Upstart Holdings Inc. is currently trading at $47.78 USD, showing an intraday gain of $2.73 or 6.06% as we speak. While most of the market is fixated on the Federal Reserve's next move or the latest inflation data, there is something much more granular happening under the hood of this specific ticker that explains this 6% jump. It isn't just about the broad fintech rebound. The real story here is a massive technical calibration that management has been working on for months to stop the wild swings in their loan approval rates. For the first time, we are seeing evidence that their system can actually handle macro shifts without scaring off their banking partners. This is a massive shift from the volatility we saw a year ago. Most people look at this as just another high-risk growth play, but the reality is that they have shifted from being a victim of the credit cycle to a company that is beginning to dictate the terms of it. If you have been watching the screens on your Robinhood app lately, you probably think you know this story. The common belief is that Upstart is simply a levered bet on interest rates. When rates go down, the stock goes up. When rates stay high, the company struggles because banks get nervous and consumers can't afford debt. That is the standard narrative you'll find on most investing sites. But the deeper reality is that while the market was distracted by the macro noise, Upstart was quietly signing massive agreements like the recent $1.5 billion forward flow deal with Castle Lake. They're moving away from the fragile model of needing to sell loans every single week and toward a more permanent capital structure. This is a fundamental change that hasn't been fully priced in yet, and it's why we are seeing such aggressive buying pressure today. The recent movement we are seeing in the price action is backed by a surge in trading volume that suggests institutional accumulation rather than just retail speculation. If you look at the Fidelity trading platform or use Interactive Brokers trading tools, you can see that the buy-side orders are coming in blocks that dwarf the typical retail trade. This happens when the big players decide that the risk to the downside has finally been capped. Just a few months ago, the sentiment was bottom of the barrel. People were treating this like it could go to zero. Now we are seeing a recovery that is outperforming even the massive gains in Nvidia stock or the steady climb of Apple stock. It's a different kind of appetite. Investors are looking for that asymmetric return that you just can't get from the megacaps anymore. We are seeing a lot of activity in the options market, too. On the Fidelity mobile app and the Robinhood app, call volume for the $50 strike price has been through the roof. This creates a bit of a feedback loop. As those calls get bought, market makers have to hedge their positions by buying the underlying stock, which pushes the price even higher. It's a classic squeeze, but it's built on a foundation of actual fundamental improvement. The company recently reported a massive jump in their conversion rate, which is the percentage of people who actually take a loan after seeing an offer. It went from 16% to over 20% in a single year. That doesn't happen by accident. It happens because their AI is getting better at pricing risk in real time, even when the economy is acting strange. Comment below how many shares of Upstart Holdings you currently hold, or if you were waiting for a pullback before jumping in. I'm curious to see if you're using a self-investing approach or if you're leaning on something like Schwab Intelligent Portfolios to manage your tech exposure. When we look at the sector momentum, it's clear that fintech is back in favor. You can see it in the way SoFi investing and SoFi stocks have been trending lately. There is a rotation happening. People are taking profits from their individual brokerage wins in big tech and moving into these beaten-down names. But Upstart is unique because it doesn't have the same overhead as a traditional bank. They don't have the brick-and-mortar costs that a company like Fidelity or a traditional Fidelity wealth management client would expect. They are a pure technology play that happens to operate in the credit space. This makes them incredibly scalable. When they add a new partner, like the recent deal with TechCU, they don't have to hire 1,000 new loan officers. They just turn on the API and let the software do the work. That partnership with TechCU is actually a bigger deal than the headlines suggest. TechCU is a $5 billion credit union, and they aren't just using Upstart for personal loans. They are also moving into auto refinance loans. This is where the real growth is. The auto market is huge, and it has been stuck in the dark ages for decades. By providing investment help through automated underwriting, Upstart is helping these smaller lenders compete with the giants. If you're using Interactive Brokers platform to track sector trends, you'll see that the credit union space is one of the last untapped gold mines for automation. It provides a steady stream of low-cost capital that helps insulate Upstart from the volatility of the bond market. Now, let's talk about what this company actually does for those who might be new to the name. At its core, it is a cloud-based AI lending platform. Instead of just looking at a FICO score, which is a pretty blunt instrument, they look at over 1,000 variables. They look at where you went to school, what you studied, your employment history, and even how you interact with the application itself. This allows them to find good borrowers that a traditional bank might reject. For years, the knock on them was that their model hadn't been tested in a high interest rate environment. Well, we just went through the fastest rate hike cycle in history, and they are still standing. In fact, they are now reporting GAAP net income that is positive, which was the big hurdle they needed to clear to prove the business model works. Looking back at their older reports, you can see the scars of the 2022 and 2023 period. They had too many loans on their own balance sheet, and that is a dangerous place to be for a technology company. But if you check your Fidelity IRAs or your SoFi active investing accounts, you'll see that the companies that survived that period are the ones coming out much stronger. Upstart has been aggressively offloading those loans and moving back to their original goal of being a pure marketplace. They don't want to be a bank, they want to be the intelligence that banks use. This shift back to an asset-light model is why the valuation is starting to expand again. It's the difference between being valued as a slow-growing financial services firm and a high-margin software company. The macroeconomic pressures are still there, of course. We can't ignore that inflation is sticky and the job market is showing some cracks. If the unemployment rate spikes, no amount of AI is going to stop people from defaulting on their loans. This is the reality that challenges the expectation of a straight line up to $100. If you are doing online investing or using investing sites to find your next play, you have to be aware that this is a high beta stock. It will move 3 times faster than the S&P 500 in both directions. That is why many people prefer to hold it in a diversified portfolio alongside things like Fidelity ETFs or Fidelity mutual funds to dampen the volatility. However, the catalysts on the horizon are hard to ignore. We have another earnings report coming up in February, and the whispers are that they might beat their own guidance again. They have been very conservative with their numbers lately, which is a smart move. They want to underpromise and overdeliver. If they can show that their new auto and home equity products are gaining traction, the stock could easily test its 52-week highs. We are also seeing a lot more interest in Robinhood investments and Robinhood crypto traders moving back into stocks like this. There is a certain level of speculative energy that follows this ticker, and when that energy meets improving fundamentals, it's like throwing gasoline on a fire. Let's talk about the risks for a second, because being an authoritative source means looking at the dark side too. The biggest risk is still funding. Even with the Castle Lake deal, Upstart needs a constant flow of buyers for its loans. If there is a sudden freeze in the credit markets, like we saw during the regional banking crisis, the whole machine grinds to a halt. This is why having a strong relationship with partners like those on the Interactive Brokers trading platform or institutional desks at big banks is so important. They need that liquidity. There is also the threat of competition. While they were the first to really move into AI lending, giants like SoFi and even traditional players are starting to catch up. They are all looking for ways to provide better investment help through technology. But here is where the reality exceeds the expectations again. Upstart has a massive head start in data. They have over 90 million repayment events that have trained their models. You can't just buy that kind of data. You have to earn it over years of operation. Every time someone pays back a loan or defaults, the model gets smarter. It's a virtuous cycle that is very hard for a newcomer to replicate. This is why even as other fintechs try to move into the space, Upstart remains the leader in terms of model accuracy. It's the same reason why people stay with the Fidelity brokerage or keep using the Robinhood app even when new competitors pop up. The network effect and the data moat are real. So, where does this leave us? The expectation was that Upstart would struggle to find its footing until the Fed started cutting rates aggressively. The reality is that they have found a way to grow and become profitable even while rates are relatively high. They did this by improving their tech, diversifying their funding, and expanding into new loan categories like auto and HELOCs. This contrast between what the market expected and what the company delivered is why the stock is up 6% today. People are realizing that they were too pessimistic. The smart money is already moving in, as evidenced by the institutional activity we see on the Interactive Brokers platform. If you're looking at your own individual brokerage account and wondering if it's time to add a position, you have to ask yourself what your time horizon is. This is not a stock for someone who needs the cash next month. It is a stock for someone who believes that the future of all lending is automated and that the FICO score is a relic of the past. Whether you are using SoFi trading platform, Robinhood stock trading, or any of the other online investment tools, the key is to stay disciplined. Don't chase the green candles, but don't be afraid to buy the blood when everyone else